be on the safe side. Okay, so this is where we are. I hope you can see the spreadsheet, the calc spreadsheet. So this is what we are doing. We are doing DP7, modeling the number of units to buy and sell. Before that, we have to, as part of that exercise, we have to first model the maximum risk per trade, and then we have to model the trade P&L. Actually, this trade P&L is essentially all the scenarios we consider. These are all loss scenarios, because this is essentially to figure out the position size, taking by ensuring that if my stop is triggered and I lose money on the trade, what is the maximum, what is the position size that I should put on, okay, in the trade, that is number of units to buy or sell, to ensure that if my stop is triggered, then my loss is equal to the maximum risk per trade. Okay, that is basically the idea here. So here, this is the maximum risk per trade, 14.29K USD. Okay, I should write this here. Let's write this here. This is what it is. Okay, so first I have to model the maximum risk per trade as a function of I cap, R cap, number of losing trades. And therefore total number of trades, percentage losers. And so you first have to model this, then you have to model the trade P&L, which is basically nothing but all the scenarios we consider are loss-making scenarios, because that's our focus. When we're trying to figure out what the position size should be, we are always going to focus on the loss-making scenario, not the profit scenario. Exit on loss, okay? And based on that, we'll model the trade P&L, and then from the trade P&L, we will just do some algebraic manipulation and arrive at the expression for position size, where we are able to model the position size as a function of the projected loss, as a function of the maximum risk per trade, which is the trade, which is equal to the trade P&L for our calculation purposes, and the entry price and the exit price, this part. And then we have to do an adjustment to convert the P&L currency, the terms currency P&L to the risk cap currency P&L, because the LHS is actually risk cap currency P&L. So although we write it in general terms as trade P&L, these are all situations of losses, okay, not profits. So P&L profits and losses, but actually these are all loss modeling actually. So, but we are writing it in general terms because the expression is valid for the general situation. Even if you are modeling a profit, if you write it in this expression, you will still, this trade P&L equation is still valid. So when you're modeling a profit, you can still use the same expression. So we have used this general expression, but the situations that you have seen are all situations of losses. Scenario 1, we were going short, we entered at 71.50 and exit at 73, that's a loss. Then 2, we were going short, we entered at 134, we exited 137.50, that's a loss. And then here also we are going short, we have entered at 75.5 and exit at 77, and that's a loss as well. So these are all loss situations, because when we modeling position size, we are interested in the loss, and we want to ensure that the ideal position size is the one which ensures that when you lose money on the trade, because when you put on the trade, you don't know what's going to happen, whether it's going to be a profit or a loss. When you lose money on the trade, you want to make sure that that loss is equal to the maximum risk per trade. Okay, so this is how you exercise control. This is a very important part of trading. If you can maintain this discipline throughout your life, the market will never be able to destroy you, because this figure itself would have been arrived at through a very conservative calculation, as you have seen here. We assume that a very high percentage of losing trades, the very conservative assumption in terms of percentage of losing trades, and then we assume that all our losing trades are all going to happen from the very beginning, one after the other, like loss, 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 all the way through. Okay, so these are very, very conservative assumptions, but these are kind of almost like a deterministic kind of modeling. as opposed to stochastic modeling, which you have in the Kelly formula, etc. But these are very determined, so very conservative. So therefore, if you plan with this kind of attitude, with this kind of focus, if you do your planning and you stick to it, then the actual losses that you experience will never be worse than this. So, and that's all you need actually. It's not that you need to make money every year. A business doesn't work like that. But as long as your losses are within budget, there is no problem. Most of the risk management disasters we have in the world, in the business world, and there are many of them, most of the disasters happen because the actual losses are much bigger than the budgeted losses, and the business can't handle it. So that's why there's a problem. Okay, so this is a very important aspect of your trading, trying to figure out the position size and making sure that you don't lose more than a very uh, conservatively estimated maximum risk per trade, per transaction, per losing trade. Okay. So all these three are clear. As I said, same principle. First, model the maximum risk per trade, then model the trade P&L or the projected loss on the trade by setting the projected loss equal to the as a function of position size, entry and exit, write it in algebraic form, and then set the P&L equal to the maximum risk per trade, and then you get the trade P&L in the terms currency. This part, first part of the expression, and then the second part of the expression is basically to convert the terms currency P&L back to risk cap currency P&L. That's it. Everything is the same. All three scenarios is the same thing. Same structure. So if you understand it in that conceptual way, that is the same basic structure. And then you can just stepwise, if you do the steps slowly, you can always do it and there will be no mistake. So you have to remember this. It's not complicated, but there are many steps involved. There's a lot of detail involved. So you should be conceptually clear about what you are doing. Never try to memorize stuff. Understand conceptually what you're doing and then do it slowly. Okay? Generally, you'll have a lot of time in the exam or doing whatever or anywhere else also. You'll have a lot of time. So that's, you don't have to hurry. Just do it slowly. Understand what you're doing and go stepwise, and there will be no mistake. But always try to understand it conceptually. Don't memorize things. Okay, so that completes our decision of position sizing. We have already had a discussion on, so in the DP7, now I have not pasted all this into, ideally we were pasting all this into these simple trading system. We can do that as well, but I have not done it just to avoid. So this thing, what I can generally do is take the whole text from this DP7, which we were looking at, and I can just paste it and repeat it here. Okay.
Sir?
Yes.
Sir, Harsh. Sir, I'm Harsh. Sir, can you please explain, sir, DP7 in short? Sir, I have not understood.
No. Which part have you not understood?
Sir, that P&L part. Sir, where you have written formulas.
We have discussed three situations. Which one have you not understood? Okay. You're talking about this. You're talking about the formula which I've written.
Yes, sir.
Okay. So, have you understood which one have you not understood? There are three scenarios.
The scenario, sir, you explain one scenario, I'll understand two other myself.
Okay. Let's
Yes,
understand the basic logic. Okay. What are the
yes,
steps involved? Okay. The steps involved is first you have to understand what this is. Position size is going to be a function of the maximum risk per trade, the exit price on the loss, okay,
yes,
and
sir.
entry price. Okay, you understand this expression?
Yes, sir.
Okay, y is equal to f of x1, x2, x3. Okay.
Yes,
So okay, so position size a function. So in this to figure out, so that is our goal. Essentially, our goal is to, because what is the problem we are dealing with right now? We have
the buy
already,
or sell position size.
correct. So we have already solved all these decision problems, and we have
Yes,
told that we have made an assumption about DP5. Now we came to decision DP7 is we don't know how many units to buy or sell. Okay,
yes,
that's
sir.
the problem. Okay, usually people decide it in an arbitrary manner, but what I'm teaching you here is that this should not be decided in an arbitrary manner as a exogenous, exogenous input. it is actually a dependent variable. Position size is a dependent variable, which is a function of all these things. This is how it should be done. Okay, that's what I'm telling you here. So in order to arrive at this final modeling, you have to do some intermediate. You have to see the maximum risk per trade. For that, those steps we had already done earlier. Remember that when we looked at what is your I cap,
Yes, sir.
what is the risk cap percentage? That is how much of this I cap are you willing to lose? Okay, this I cap is your liquid funds. Okay, this is a part of your liquid funds which you can deploy in the market to buy assets or commit to margin capital, etc. But you don't want to lose the entire I cap. Okay, so you have to answer this. You have to answer this question for yourself. How much of this I cap am I willing to lose? That's R cap percentage. Okay, that's your R cap amount, and then you project the number of trades. How many will you do? What will be the percentage losers? Total number of losing trades. Then you divide the R cap by the losing trade. You get the maximum risk per trade. Is this clear?
Yes, sir. Yes, sir. It is clear.
Okay, up to here is clear. Now, this is the first step coming to this. Then you have to then model the trade P&L. Okay, trade P&L is a general expression. We are modeling it. Okay, but this right effectively the scenarios we are considering are all loss-making scenarios. Okay, because we are essentially in terms of when you're talking about figuring out how many units to buy, we are really focused on the loss-making scenarios. But the expression that we are going to write is a general trade P&L expression. So when you put in, if you make a profit also, if you use the same algebraic formula, you will still get the same result. Okay, the correct result. You'll get the profit. Okay, so now you tell me where you don't follow. Okay, so next step is to model the trade P&L. And in each scenario, what we have done is we have first modeled the trade P&L, and then we have figured out the position size by just cross multiplying and moving some terms around. Okay, so let's take one example. In the middle one, let's take scenario 2, or let's take the most complicated scenario 3. Okay, what did I tell you? That there are two parts to the modeling of the trade P&L. Okay, so first, remember, to come to the modeling of position size, first we model the trade P&L, and then we just do some cross multiplication and come to position size. That's not a problem.
Yes, sir.
This has to be, you have to be clear about this trade P&L. Trade P&L is always going to have two parts. The RHS will have two parts. The first part will be the P&L in the terms asset. Here. The first part is always going to be like this for all three scenarios. Are you following?
Yes, sir.
Has to be this. This is the general expression. Exit minus entry, brackets into position. And if you have a short position, then you write it with the minus sign. Okay. So RHS, LHS is trade P&L. Okay, which we are later on going to set equal to maximum risk per trade, which we derived earlier. Okay, but initially the general expression we are writing for trade P&L, any situation of entry and exit with a certain position, the trade P&L is going to be this. This is going to be the trade P&L in the terms asset. Okay.
Yes.
Generally, we trade in the base asset amounts, so therefore P&L comes out in the terms asset. Okay, so this is the first part. The RHS will have two parts. The first part is this P&L in the terms asset. But remember this rule here. It is not sufficient to have the trade P&L in the terms asset, because what if the terms asset is not the terms currency is not the risk capital currency? You have to then convert the trade P&L and the terms currency to risk capital currency. Is this clear?
Yes, sir. It is clear.
Okay. So basically this part, let's talk about this formula here. Much section scenario 2. Okay. The scenario 3, the second part is very long text. Okay. So essentially what we're doing in the second part is we are just using a factor, okay, where we are just, the job of that factor is to convert, because the LHS must be in the risk cap currency. and the RHS normally comes out in the terms currency, which is why. And now in the first scenario one, the risk cap currency is the same as the terms currency. Terms currency is US dollars, risk cap currency is US dollars. That's why there's no adjustment required, which I said is an adjustment factor of 1. Okay, so but essentially because 1 means converting US dollars to US dollars is 1-to-1 exchange rate.
Yes, sir.
Okay, so therefore, once you understand this, then you can solve everything by proceeding in a slow and stepwise manner. The RHS of the PNL modeling will have 2 parts. First part will generate the PNL in the terms asset. And the second part will be a factor to convert the PNL in the terms asset to PNL in the risk cap currency. Okay, you understood the second part?
Yes, sir. I know.
Okay, so let's take the more complicated. Now let's take the most complicated example. In the case of Aussie Yen, okay, third scenario. Okay, now if we take Aussie Yen, okay, PNL is, this is the first part. Let me move the second part away for now. Okay, RHS first part, PNL and terms currency. Okay, but that's not good enough for us. We need a second part also. We have to convert. So this currency, this PNL is coming out as this Aussie Yen. This PNL is over here. Okay, this is my PNL in terms currency, which comes from, if you see, the position size times the exit minus entry price, okay, times into the position size, which is nothing but this part of the formula here. Can you see this?
Yes, sir.
Okay, so now what is this market? This market is Aussie Yen. Aussie Yen trading means that generally my PNL is going to come out in the terms currency, which is Yen. So this PNL which I have is a terms currency PNL, which is a Yen PNL. Okay, but my risk cap currency, okay, as it says here, is USD in all scenarios. Okay, so therefore now I have to do another factor. I need another factor in the RHS to convert this terms currency PNL to a risk cap currency PNL, which means I have to convert a Yen amount to a US dollar amount.
Yes, sir.
Now, what do you do when you have a rupee amount that you want to convert into a US dollar amount? You divide by the dollar rupee rate.
Yes, sir.
Okay, why do you divide by the dollar rupee rate? Because the dollar rupee
Factoring in, so for converting rupee into dollar.
Yeah. So the reason you divide, not multiply, is because the dollar rupee exchange rate is expressed as dollar as base currency, rupee as terms currency. So dollar rupee exchange rate of 75 means $1 is equal to 75 rupees, because the dollar is the base asset. Is this clear?
Yes, sir.
That's why you divide the rupee amount by the dollar rupee exchange rate, not multiply. Okay. So same thing. There is no difference between, for this kind of, for the purpose of this calculation, there is no conceptual difference between the dollar rupee and the dollar yen, because in both cases the yen and the dollar is the base currency, and the yen and rupee are the terms currency. Is this clear?
Yes, sir.
So in the second part of the RHS, your job is to write a factor which will convert the terms currency PNL to the risk cap currency PNL. So basically a terms currency amount has to be converted into a risk cap currency amount. So that's why I have written this long sentence, okay, which now we can move back to write the formula properly, is here. Okay, let me make this a little smaller so that we can see it in one. Okay, still not in one line, but 2 parts. Okay, here we can put. All right. So the second part is basically nothing but I've written a long sentence here. exchange rate between terms currency and risk cap currency at the time of exit. Is this clear?
Yes, sir.
Okay. So this is what, so if we divide this by this in the case of the dollar yen, okay. Okay, this actually has to be made even more general. We have taken the example of Aussie yen. If we have more complicated scenarios, actually this should not be written as a divider sign. Actually, it should be written as a multiplier factor, but I'll not complicate it for you. So when we write factors, okay, they are always written as the general way of writing in mathematical symbols is we always write it as multiplied with each other. Okay, so like when you do present value annuities and all that, you do present value annuity factor or a time value factor. These are always written as the factors are always written as multiplied by. Okay, so actually it should be multiplied by 1 by the exchange rate. So therefore, anyway, so but anyway, this is written really for the examples that we have given you. So as long as you understand what is being done, there is a factor that needs to be put in here to convert the risk capital in the terms currency PNL to a risk cap currency PNL. So we divide it by the exchange rate between the terms currency and the risk cap currency. Okay, at the time of exit, and that's all we are doing. So what we are doing is we are making an assumption that since we are exiting at Aussie Yen, right? We are exiting at 77. So this is what I said. This is a projected exchange rate. So scenario 3 is different from scenarios 1 and 2. The ideal position size modeling that you do in scenario 1 and 2, this is an exact figure. Okay, this is the figure you can rely on with certainty because there is no uncertainty in these two scenarios. Okay, it's always going to be this. Okay, if you put on this kind of position and there is no slippage, then your loss is always going to be the loss that is shown here, 15K and 25K in these two scenarios. But in scenario 3, there's a difference. You have to understand this because now what is happening is you are modeling something on the LHS, but one of the terms in the RHS is a term, the value of which cannot be known with certainty. Okay, this is a very important thing because in the scenario term on the right hand side. In scenario 1 and 2, the terms on the right hand side were all known with certainty. Okay, because these were exit prices, based on the way that you are going to exit. Here, the exit price was the Aussie rate itself, and then here there was no exit. Actually, we didn't have to do anything because the PNL currency and the risk cap currency was same. Second one, we knew that exit was going to happen at this rate. And so we use this rate to convert the candy loss to a dollar loss. And there's no uncertainty here. But here there's uncertainty because I have no way of knowing, and nobody has any way of knowing. What the question we are asking here is this figure, this 105, is a dollar yen exchange rate. Okay, here, exchange rate between terms currency and risk cap currency at the time of exit. Now, this is projected. Okay, what we are asking is, what will be the dollar yen exchange rate at the time? Remember, dollar yen exchange rate, not Aussie yen. Dollar yen exchange rate at the time that the Aussie yen goes to 77 when my stop is triggered and I lose money and I crystallize my loss on the trade. At the time that the Aussie yen goes to 77, what will be the dollar yen exchange rate? Answer is, it is not possible to know what this will be. Nobody will ever know. There is no way to know. But you can make an estimate. Okay. So that's why this is a projection. This is an estimate. So this is an important thing to understand when you're doing any kind of modeling, that in your RHS, among your independent variables, okay, among your independent variables, are there any such variables? Now this is the part of this is your dependent variable. These are your independent variables, okay? This one, this one, and this one, and this one. So this one has 4 independent variables. LHS, dependent variable. RHS has 4 independent variables. This one, this one, this one, and this one. because remember this one is different from this one. Okay, these are Aussie yen rates. This is the dollar yen rate. So here, what is happening is theoretically try to understand what is happening. You have a problem because the one of the independent variables is such that the value of that independent variable cannot be known with certainty. Okay, no way you can know this. What will be the dollar yen rate at the time that Aussie yen hits 77? Nobody knows. So you have to understand that the LHS modeling of position PNL, trade PNL that you get in this exercise scenario 3, there is a certain uncertainty about this because this item here is uncertain. The value is uncertain. It's an estimate. So if you estimate something and the value turns out to be much very different, okay. So like for instance, suppose I estimated 105, and suppose it turns out to be 145. Okay, so I estimated 105 and I came out with a position size of 1 million. But suppose the actual value turns out to be 145. Now you see how much the ideal position changes. Okay, it changes almost by 40%. So big change. Of course, this kind of big move does not happen, but you never know. Anything can happen in the market. The point to understand is that this figure that I put in, okay, this is an estimate. So therefore, you have to understand in modeling terms, when you do all these modeling situations, you have to understand, you have to think about these models in these general terms. LHS, dependent variable, RHS, independent variable. Generally, we write it like this. Now, examine the independent variables. How many are there? 1, 2, 3, and 4. And what is the nature of these independent variables? Do we know their values with certainty? Well, there's one independent variable whose value is not known with certainty. Okay, so you have to understand it. Therefore, this model is less reliable than other models where the value is known with certainty. So, for instance, if I'm modeling rainfall in Delhi today as a function of snowfall in Shimla 1 week ago. Now, what was the snowfall in Shimla 1 week ago? There is no uncertainty about that. I can just call up the Met Office and find out what was the snowfall in Shimla 1 week ago. And then I can model my rainfall in Delhi today. So this is an example of a model where the independent variable is not, there's no doubt about the independent variable. The value is known with certainty. So when you're looking at any model, you should ask yourself these kind of questions. What are the independent variables? What are the independent variables? Are their values known with these kind of questions you should ask? Okay. So yes, Harsh, how is it now? Is it better?
Yes, sir. Now I understood.
Okay. So now if you remember this basic framework, and then you just study it and practice it once or twice for yourself, you'll be able to do it.
Yes, sir.
All right, just remember everything that I'm teaching you in finance is all of it is conceptual. Okay, some of it is not conceptual, like when I tell you that in the Aussie Yen market, base asset is Australian dollar. This is not a conceptual thing. This is a contextual. You have to understand the difference between contextual and conceptual. This is contextual information. That this is how the market trades. This is the convention. Just like when you go to the US, somebody tells you that be careful here. We drive on the right-hand side of the road. Nothing conceptual about that. This is just contextual information. Okay, this is just information. But you need to have information. You need both types of knowledge, both contextual knowledge as well as conceptual knowledge, conceptual clarity. So this part is not conceptual. That Aussie is the base asset. But pretty much everything else is conceptual. So you have to focus on understanding concepts. Okay. So some of you, I think, are still stuck in the old mode. I don't blame you because people are conditioned in our education system to mug up stuff. But that way of learning is not going to be helping. It's not going to be helpful in the corporate world. So you have to get out of that mode and try to understand stuff. Okay. So is this clear? In the case of Aussie Yen trading, I've given the formula projected JPY rate. No, this is projected. I'm highlighting it once again, which means this is just an estimate and there's no guarantee that this will be the correct figure. Okay, so yeah, and this I've just written, this whole thing I've written equal to at the rate, and then I've written a simpler expression. I cap versus R cap we've already discussed, and then pyramiding we've already discussed before. Okay, all right, so these are there at the lower end of your notes. Just bring it up. All right, so this completes the discussion now. So DP7 discussion is completed, and so this is what we are doing. Since we are not recapping the pyramiding discussion right now, so this is what we have discussed is the buy sell of the initial position size. Okay, initial position size, so that you have essentially you've got the initial position size. So we are not considering the pyramiding part, but the pyramiding has already been discussed earlier in an earlier video by Siddharth had asked this question. So we had already discussed pyramiding there. So all right, okay.
Yes.
Yes.
For an exam point of view, we can study from notes master file from this file.
This I already explained to you earlier in the session, in the first part of the session, that you have to, the session notes are basically just a marker for us, like bullet points,
Yes,
to just tell us, okay, what did we study on this day? Okay. And essentially you have to cover, there are two types of material in the syllabus. One is everything I've covered in the class, including discussions with everybody after the end of the class, with a few students at the end of the class, which is captured. Everything that's on the videos is part of your syllabus. Okay. And then the other type of material that is in your syllabus is those, I don't know, 8 or 9 or 10 chapters which I told you to do self-study on. Yeah, these ones. Because you need them for your project. Remember?
yes.
I can highlight this so that you guys are warned about it. Which color do you like? Let's do yellow. Okay. Right? So these chapters which are there in your notes here, okay. These are your link to notes. Some of them have videos as well. Okay. These chapters, in addition to all the material in the videos, that is basically everything that's been covered in the class. This clear? That's your syllabus.
Okay.
All right. Okay. So now we'll go on to, so we finished the position size. Now what we'll do is we'll go on to a further discussion of, a detailed discussion of DP5. Okay. So because earlier we had made a discussion and we'll try to understand this important aspect of it, will also help you with your order placement. Of course, your project is almost over, but remember that everything you're learning, and also remember one more thing, that as far the way I teach finance is, I don't make a distinction between these three courses, IPM, IFM, and FTRM. They are basically three parts of one same course. Okay, it's just you're doing three different projects, but there is a lot. Most of the material you're learning here is going to be applied in the next two courses also. That's the right way to study finance, not to split it up like that, in a silo-based approach. So what we are learning now in order types, okay, when we study order types, which is order types are related to DP5, okay, that all that material will be applicable throughout your career and throughout the next two courses as well. Okay, so now we've already had a brief discussion, so I'll only mention it very briefly. So now what we are doing is we are going back to DP5. We have already constructed our system, okay, and this system can be used. There is no need to, for entry price, we made a assumption. We made an assumption that we will initially enter, we initially made an assumption that we will enter always at the market price. So we automatically solve this DP. Then we said that this is not required because As you remember, there was a discussion that we had with, initially I told you this was not required. I'll just briefly explain why it's not required in a basic system. If you remember now, earlier we gave the example of FCX. We go back. All right. So what we said was that Sachin went long FCX at this point, and when he did that, he put a stop here. He went long here, and he put a stop over here, and then he waited as the market kept on climbing, and then the market made another new high from a new low, from a new higher low. Initially, he was at this low, and then he was waiting to see if there is a new higher low that is formed. And then the market went up to this point. At this point, he was able to see a new higher low from which a new high was made. Okay. So then what he did is he took a stop from here and he dragged it and moved it here. And then what he did was when this was formed, when the market went up here, he saw a new higher low from which a new high was formed. New means relative to this. This one is now new. Relative to this one was new. So then when he sees the new higher high formed from a new higher low, then he drags his stop loss from here, moves it there. And so on and so on and so forth. He moves it, then next step he moves it here. Next step he moves it here. Okay. Then finally what happens is this gets broken. This level gets broken. Okay, so say around 1507. So Sachin went long at say 11.5. Okay, at 11.5 he went long, and initially he was looking at a loss because if it didn't work out correctly for him, he was buying, and 11.5 he bought it at 11.5, and then he had put a stop initially at 968, 970, let's say. Initially, I was looking at a loss, entering at 11.5, losing money, exiting at 9.7. If it didn't work out, but as it happens, it worked out for him. And so instead of actually doing this, which is this, instead of having what we call a targeted take profit order, okay? Targeted take profit means, suppose he is here and he sees the market rising, he has bought it here, he sees the market rising, he puts a target, he's saying, wow, this is looking great, I better get out at 14. So he would put a limit sell order at 14, okay? And then he would get out at 14. That's a targeted take profit order. But he's not doing that. What he's doing is, he is taking this decision problem out of the picture. He's actually removing this decision problem, just like we removed this decision problem by assuming entry at market. He's removing this decision problem by making it simpler. He's saying, I don't need to predict when the market is going to top out. I don't need to predict what is the end of the uptrend. Okay, because remember we discussed one statement, which is what momentum traders believe, that the trend will continue until it ends. What does that mean? When you're here, the uptrend is going on, low, 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 here, low, low, higher low, all higher lows. Uptrend is continuing until it ends. When does it end? It ends when this is broken. It ends basically around here at this time. So this is what momentum traders believe, that the uptrend will continue until it ends. So here what Sachin is doing is, instead of trying to predict when the market uptrend will end, he's saying, let the market tell me when the uptrend is over. I don't want to make a prediction about that. So he has removed this decision problem. He's saying, I don't want to bother with this solution, directly making a limit by making a prediction about when the market will turn around. Rather, I would just use the solution to 6.2 to proxy the solution for 6.1. Okay. So I will use the solution method for 6.2 to proxy the solution for 6.1. And why is that a solution for 6.1? Remember, we use the expression trailing stop. If you go back in your notes and videos, you'll see we discussed the trailing stop. This is what a trailing stop is. It goes along here with a stop over here. Then market keeps rising, moves the stop over here, then moves it here, then moves it here, then moves it here. When does he move it here? When the market rises to this. When the market rises to this, he moves it here. When the market rises to this, he moves it here. When the market rises to this, he moves it here. So why is it a trailing stop? Trailing means that running behind. Okay, trailing is running behind. So why is it trailing? Because it's trailing the market. It's always behind the market. Like the market goes here and then he moves it here. Okay? But it's a trailing stop. But essentially what is happening is he's solving this problem, exit price with profit. Why do you need to have a plan for this? Because you want to protect your profit also. You buy something here, it goes up all the way here. Okay, you want to be able to capture some of your profit. That's the goal. So the thing is that you can do that. You can capture some of your profit by all without having to actually predict when the market will turn around and start going down. You can actually let the market tell you when the trend is over, because you believe that the trend will continue until it ends. The trend is continuing until it ends or gets neutralized. So what you do is you use a trailing stop. So the same logic by which he decided that this was going to be his stop when he went up here. Why? Because if this breaks, then the pattern of higher lows is broken and the uptrend is destroyed. And he has no basis for being long, because the reason he went long is because obviously he thinks that the market is going to move higher, because that only then will he make money. The market moving higher, another way of saying it is that the uptrend is still intact. It will keep on moving higher. So which means there's going to be higher highs, higher lows. The moment there's a lower low, break of this, that breaks the assumption on which he's based his long position. So therefore he must remove his long position. That's why the stop is here. So when he moves the stop here and here and here and here, he's using the same logic that led him to put the stop here. So the same logic is being used to move the trailing stop. Okay. So therefore all he's doing is he's only solving 6.2. But by using 6.2, you can use it as a proxy to solve this decision problem instead of thinking about when the market is going to top out. Okay, so this is why it's called a trailing stop, because the stop is always behind the market. When the market is here, stop is here. The market is here, stop is here. Market is here, stop is here. So it's trailing the market, is behind the market. That's why it's called a trailing stop. But you can use the trailing stop to solve the problem of protecting your profit. You notice that Sachin goes long at 11.70, and when his trailing stop is finally triggered, it's around say 15.10. So from 11, he went long at 11.70, and he is finally, his position is closed out at 15.10. So he has made money, right? Although he never used any take profit order. Okay? And that's why we said that that's why we don't use the expression stop loss, because although a stop order has been triggered, there is no loss as such. Okay, there is a profit. So therefore, a stop order can also be used to protect profits and to capture some profits. So that's why we say stop order, not stop loss order. And so, as you can see, that some people might say that it would have been better to sell at this point, but of course you don't know whether this is going to stop here or is it going to continue to 2025. Nobody knows. Okay, so what you're doing by keeping it here is a very good system actually, if you have the discipline to do it. Okay, I do it in my own trading. I don't use take profits anymore. I used to use them earlier when I was a younger trader, but I don't use it because I feel let the market tell me that the trend is over, and it keeps it makes the system even simpler, and you don't have to rack your brains about when the market is going to top out. So you just keep moving the stop, and then eventually the market will stop you out. Okay, so this is quite a legitimate approach Okay, so we solve this problem. So yeah,
Sir? Hello.
is there a question?
Yes, sir.
Yeah, what is it?
Sir, can you show the graph again? Sir, in this scenario, sir, there is a new law at October, uh, at the end of September month.
Yeah, around here. Yeah, pretty
Yes, sir.
pretty good.
So, sir, the investor will go short accordingly because the previous law is broken.
So that going short, we are actually discussing a situation where a person who had gone long is using a trailing stop to protect his profits. That's the situation we were discussing. And we were saying that once this breaks, this finally his stop is triggered and the long position he took at 11.7, that is finally stopped out here. Okay. Now, as to your question of whether you want to go short, if you remember when we discussed the buy or sell bias, DP4, when we discussed mean reversion traders, okay, what we said is the mean reversion trader can go short once this is breaking, once this breaks, but that means this has to be the trading time frame, and this is the shorter time frame, and the longer time frame should also be negative, okay, because remember the conditions. Go back and check your notes. The answer to your question is a mean reversion trader can, yes, go short, but in this situation which we were discussing, we were talking about a person who was already long and then he gets stopped out here and then his position becomes square. If you're talking about a new short position, that will apply only to mean reversion traders who who believe that this trend will turn down, and this is a sell signal for them, provided the bigger picture, like this is the smaller picture, the trading time frame, provided the filter or the bigger picture trend must also be down. Okay, so you need to have the bigger picture trend be down and not neutralized, and only then can you go and go short here as a mean reversion trader. This is clear. If you go back and check your mean reversion lectures, you will understand this. This is clear now.
Okay. Yes.
Okay. All right. So now let's go. Now we have done this. So now you can see that you have a very simple basic system by solving only this, making an assumption about this, always enter at market, and not even bothering with a direct solution to exit with profit, rather using the 6.2 as a proxy, 6.2 solution logic as a proxy for indirectly solving exit with profit. Why? Because you see that by using 6.2 logic, Sachin is still able to lock in some profit. It's not that he's losing all his profit. He's still able to lock in some of his profit from here to here by using just the logic of 6.2. So therefore we say we can indirectly solve 6.1 by using the logic of 6.2. We don't have to bother with 6.1. So, and then we discussed on position size, how to figure out how to model the position size. Okay. So now let's come back and try to improve our system a little bit. This is a very basic system, okay, where we try to solve. This is given to us by the investor, and we only solve the addition, this one, and this one, and we have a very basic system. Takes care of all the problems. Now let's try to improve it, and let's go back to DP5 and try to learn about order types, how the order types relate to the entry price DP. So let's try to understand the order type. We have already done this actually. So we said there are three options for entry. You can once you figure out, let's say, if you just take FCX itself, once you figure out that you have for the moment we'll not worry about the big picture. We'll assume this is a small picture and only one time frame, trading time frame. Assuming that you have a bearish bias in this market. Okay, so DP4 solution is to have a selling bias. Now the question is entry price. You have three basic choices. You can go short directly at market. Okay. Or you can say, if we zoom in a little bit, you can say that maybe this will rise to about, the market is around 16. Let's say you will say that it will rise to about 1660, but not go above this. And then it will fall and go down below 14 again, okay, far below that. So in that case, you would not sell. So one option is to sell at 16, and that you do if you believe that the market is going to just collapse straight away, that I'm not going to get any better chance to sell, I better sell it right now. Okay, and instead of 16, if I get 15.9 or not, I don't care, because I'm worried the market is going to collapse. So just place a market order and it will execute immediately, but there's no price guarantee. Okay. So you have this fear that the market will drop, you use a market order. Otherwise, if you have a different view, so the orders that you use, okay, let's put it, let's bring this here. Yeah, okay, fine, let's have it here. So the orders that you use, okay, are these three orders that you use: market order, limit order, stop order. They are all based on a particular market view. Okay, so you have to understand that what kind of order you are going to use, that depends on your market view. Okay, so whenever if you do any kind of job in finance, you will have to take a view on the market. Okay, you can't say that maybe this will happen, but maybe that will happen. Eventually, you have to take a position and commit yourself to one side. And so, here you've taken a. So if your view is that the market is going to collapse immediately, let's assume DP4 is a bearish bias, so you have a selling bias. Now, question is, at what price will you enter? What should be the entry price? At market, at price more favorable than current market, or less favorable than the current market. Okay, so I've written this here. More or less is relative to the current market. At current market, at more favorable, at less favorable. These are your three choices. Okay, so if you feel, now this is driven by your market view. If you look at the chart, you feel the market is going to collapse, then you will use a market order to enter the trade. Now, if you feel that it's not going to collapse immediately, I think it's going to go to about 16.6 or so, and then collapse. So why should I sell if I'm pretty confident it's going to go to 16.6? Why should I sell at 16? I would rather place a limit order to sell. Okay, so as you can see, limit order is more favorable price than the current market. Okay, so obviously you can see that selling at 16.6 is better for me than selling at 16. Okay. So I would use a limit order if my view is that the market will show some correction, okay, against the larger trend, some correction, and then it will start moving in the direction of the larger trend. So I will take advantage of that counter trend correction and sell and enter the market at a more favorable price. Okay. That's your thinking for using a limit order. And a stop order is used when essentially you're looking for confirmation. If you remember, this is the second type of entry that Vipul had discussed in one of our classes. But what he's saying is, so when I said that at this point the mean reversion trader can go short, assuming that the big picture is negative. The picture has to be negative, and this is the small picture, trading time frame. The guy is waiting to sell, can't sell, can't sell, can't sell. First break of trend here. First break of trend. Now he can sell. So now what Vipul said was, okay, so selling now, he can do something else. He can wait for a break below even this low, okay, and then sell. Okay, so if you see now what would happen, once it breaks below this low, this is basically first high, first low, somewhere here, second high, and then break below this, so second low, because lower than this first low. Okay, so once it breaks below this, and so this is what Vipul is saying, instead of selling now or here, I will sell when this breaks. Okay, when this breaks, new low is made. Now, this is also a type of method that you can use to enter, which means although you have a selling bias, you are still not 100% clear. You're looking for more confirmation. So therefore, and you feel that more confirmation comes when this is broken, because that means you have a high, you have a lower high, you have a low, and once this breaks, you have a lower low, lower than this, you have a lower low. And the lower low, basically this two highs and two lows, they imply the start of a downtrend. So this is the logic for entering the position here. In this case, what you do is you use a stop order, a sell stop. Okay. This here, if you use this is a sell limit, sell market, and sell stop. Okay, or stop sell. A sell stop is better. You use a sell stop order. Now notice that if your plan is to go short only, say roughly about around 14.6. Okay, so if the current market is 16 and you're going short at 14.6, that is less favorable than the current market, using a stop order. Okay, so obviously it looks kind of stupid. Why sell at 14.6 when you can sell at 16? And the answer is that we are not ready to sell fully yet. We need more confirmation. So that's why we're waiting for this kind of a break. Okay, that's basically the answer. So that's why sometimes people use this kind of entry order. This is also a very legitimate method. There's no need to be worried about using it. If you feel once you're comfortable with the logic, you can use them. Very logical. Now we'll come to this kind of a situation. So this market order and all, you can just read up on this number of parameters. Market order, we say, has 0 parameters. Okay, obviously buy or sell is not a parameter. Okay. So market order has to be entered as either a sell market or buy market. We don't treat that buy or sell as a parameter. I think I've written it somewhere here. In one of these places, I've written that buy or sell is not a parameter. Okay, I'll just write it once again. When we write parameters, all right. So market order 0 parameter. You can figure out you can study this stuff on your own. Okay, it's not very complicated. Understand these concepts. There is a guarantee of execution, but there is no guarantee of price. Okay. Then you can read. This is from the IB web page. Actually, I just copied it. Then limit orders. Limit orders. What you have is guarantee of execution. There is no guarantee of execution, but there is a guarantee of price. Obviously, why no guarantee of execution? Because market is here and I place a sell order at 16.6. There's no guarantee the market's going to go there. It may just collapse straight from here. There's no guarantee of execution, but if it goes there, then I will get a fill at 16.6. Okay, they can't execute a 16.6 sell limit order. They can't execute at 16.5. That's why there is a guarantee of price. Okay, you can understand the stop order. You understand stop order. Basically, the logic is that a stop order is like a modified market order. Okay, it's basically like you can think of it as a modified market order. Modified market order, or a conditional market order. Modified is not a good word. Conditional market order. You already know what market order. Market order means system is being told, just sell it or just buy it. I don't care what the price is. Just buy it or sell it immediately. Okay, as quickly as possible. And this is what the system understands. Okay, and so directly you enter a market order, and then the system goes into the market and tries to sell it immediately or buy it immediately. without worrying about the price. And later on, it comes back and tells you, okay, your price is, your order is done, and this is your price. Okay. In the case of a stop order, you can think of it as a conditioning marker. What is a stop order? Stop order, let's say this way here. So the bull goes short at $16 on FCX and puts a stop at 17.5, let's say. Okay. And then he goes on holiday. Okay, so he start at $16 and stop at 17.5. The system is keeping the stop. It is a GTC stop. Good till cancel system is keeping the stop. So system is basically watching what does the system understand. Once if you notice, a stop order has parameters. Okay, it has one parameter. Okay, what is that parameter here? So what does Vipul play? He has gone short at market. First, he has done his entry. He has gone short at market. Then he has placed a stop order. Okay, so stop order he has placed. He has to write the trigger for the stop trigger level. That's the parameter. One parameter, stop trigger levels. He has to tell the system 17.5 stop, buy stop. Okay, since his position is short, he has to put a buy stop, and it's got one parameter. Okay, 17.5, and that's the, what is the system logic? What does the system understand? The trading system. The trading system understands that I'm watching a conditional market order for Vipul. And what is the condition? Condition is the market trades to 17.5. As soon as the market trades to 17.5, the system will immediately transmit a market buy order into the market. So that's why it's a conditional market order, because there is a trigger level involved. Notice that in the market order, there is no zero parameters. In the stop order, there is a parameter, one parameter, the stop trigger level, which in this case is 17.5. So buy stop at 17.5, system understands the conditional market order. Condition is hitting 17.5. As soon as it hits 17.5, immediately the system transmits a buy order into the market. Okay, that's just as like same as any other market buy order, but it is not transmitted immediately. When Vipul goes short at 16, it's not transmitted immediately because it's a conditional market order. So the system holds it in this, in its archive, and watches the market. Once the 17.5 is hit, then it transmits his buy stop order as a market buy order. So there's another way of understanding stop orders as a conditional market order. All right. Okay. Now let's understand this very important thing actually. Breakout trading systems. We have discussed it briefly. Going back to the stop orders. Okay. Now why? Okay, the breakout trading system is, we've looked at this definition of trends and all that. You know, trend is higher highs, higher lows. Okay. So a breakout trading system is basically this. It's a trading system which is breakout trading systems become bullish when a new high is made and bearish when a new low is made. Somebody has a question or somebody is not on mute? Someone is not on mute. Okay. All right. So, okay. So understand breakout. What is a breakout trading system? Very simple. It basically, let me put it this way. Let me put a very simple definition.
Sir, in this N period is 52 weeks.
No, N period can be anything. N can be anything. You can make it
Okay,
4
sir.
weeks, 10 weeks, 19 weeks, whatever you want. Okay. N can be anything. Okay. All right. But the basic thing is all entries and exit using stop orders and always use trailing stops. Okay. Always use trailing stops only, which means there is no targeted take profit. They will always use trailing stops. We just discussed trailing stops. Okay. This is the definition of a breakout trading system. All entries and exits using stop orders only. Okay, which means this is what it's going to mean. The same thing we told you just now, that when the market is over here at 16, then Vipul wants to place, he doesn't want to go short right now because he's not really sure that it's going to go down. He's going to become sure once the downtrend starts. That is two lows, two highs. So that's why what he does is he places a sell stop at say around 14.5 whatever, 14.5. He places a sell stop at 14.5 because below 14.5, this is called a breakout entry. Okay, this is a breakout type of entry because it is, I mean, you can say that there is some kind of a trading range here and it's breaking out of the trading range. Okay, that's why the name comes from. So this is the breakout trading system. You have to understand the basic nature of this system is this, that all entries and exits are going to happen using stop orders only. No market orders, no limit orders. Okay, so entry into trade and exit from trade also using stop orders. Okay, so in this case, Vipul will enter, suppose it drops straight away from 16 below 14.5, then he will enter with a stop order at 14.5, a sell stop. Right now he has zero position, he has a bearish view, but he's not very confident. He will become confidently bearish once he gets a confirmation by starting a downtrend, when the market starts a downtrend, by marking a low below 14.5. Then you have two lows and two highs, lower lows, start of a downtrend, according to your definitions. Okay, remember those definitions, conceptually understand them, then you understand the breakout trading system. These are kind of confirmation based systems. Okay. So now first entry is through stop order, sell stop order. Then after the sell stop entry order is executed, that means he has a short position now at 14.5. Then he's going to put a buy stop at 16. He assumed the high is 16 from which the new low is made. The high is 16. So then he's putting a stop buy order. This is to limit his losses. Okay. So this is a buy stop order at $16. Okay. Entry via sell stop order at 14.5. If there is any, loss happening, exit also planned via stop order at 16. And then if it keeps on going down like this in a jagged format, maybe some lowest low will be $11, then he would have used a trailing stop and moved his stop down to $11. Okay. So if we look at some others, maybe if you look at some other stock, Morgan Stanley, let's see how Morgan Stanley is doing. Still not really, not much of a downtrend here. Not here, not much here. Let's look at some of the airlines are doing very badly. Maybe we can look at some airlines. Okay, so here, if now there's a first break here, and then the breakout trade entry is once this breaks through here. Entry via sell stop, then place a buy stop here to protect the loss. Market keeps making lower lows, lower highs, then by that time you moved your buy stop from here to here. Okay. And so this is a trading stop method. So this is what it means. Breakout trading systems are basically that we are going to make all entries and exits happen only using stop orders. And we are always only going to use trailing stops. This kind of follows actually, because if you use targeted take profits instead of trailing stops, you would have started using limit orders. So if I put a ban on the use of market orders and limit orders and I force you to use only stop orders, then you are only able to use trailing stops because you cannot use any other kind of exit method. Okay, so even your 6.2, 6.1 also will be solved by indirectly solved by using 6.2 logic because you have to use trailing. Now the beauty of this kind of a system is, let's look at some stocks. Yes, somebody has a question.
Yes, sir. Sir, can you show the graph of LUV again? Sir, suppose in this the time frame is from July to October. So then the stop order will be at 57.
Which July to October? This July, 19 July, July 19, 2019.
Yes, yes, sir.
2019 to today.
Yes, sir.
Yeah. If you're looking at these big patterns, high, 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 low, 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 this is the size of zoom you're looking at, then your short position stop will be here. If you are already short, the stop will only be here. And
Okay, sir.
this is the lowest high from which a new low was made. Correct? Because these are too small and have not made any new low from this high. Not yet. If later on, if tomorrow morning it comes and Monday morning it drops straight away from here to 20, new low, then we can place lower the stop from here to say around 45. Got it?
Yes, sir. If this low is break, which is at 22 or 23.
Yeah. That's why I said on Monday morning, suddenly it drops 20, then you can lower the stop to 45.
Yes, sir. Then I can shift my stop. Okay.
Yeah, got it? Okay. All right. Now, what was I saying? Let's look at some stocks which have. Now, we want to discuss breakout trading systems, and in that, we want to learn about breakout trading systems. They're very important. Okay. There is a basically, I've already written all this here. Okay. We want to learn about a very famous breakout trading system called the Donchian 4-week trading rule. Okay. You can read about the turtle traders later on. Interesting story. But conceptually, you have to understand, you have to remember your definition of trends. Okay, higher highs, higher lows, starting of trend, condition for starting trend, condition for maintaining trend. And you have to remember these are all breakout trading systems are basically all done by stop orders. Okay, so what we are discussing is breakout trading systems. This is a property of breakout trading system. And what particular system you want to understand? Donchian 4-week trading rule. Okay, so there's a guy called Richard Donchian. That's why it's called the Donchian trading rule. It's very simple. It's understand that this is a type of breakout trading system. Okay, Donchian trading rule is a type of breakout trading system. So it will have all the properties of it's a species of breakout trading system. Okay, so it will have all the properties of breakout trading system. So just like if I say an LLB student is a species of WIP student. That means whatever properties we have defined for WIP students, that LLB student being a species of WIP student, he must exhibit all the properties of WIP students. Okay, that is the meaning of this kind of expression. Okay, so a Donchian 4-week trading rule, most famous breakout trading system. Okay, let's understand it. Very simple. Let's assume that these are all 4-week highs. Okay, they are actually not because they are different time frames. But let's assume for the sake of argument. Okay. So basically what the Donchian 4-week trading rule does is, you can read about it. I'm giving you a link also, but I'll just explain it to you. It's very simple. Once you understand that it is a species of breakout trading system, which means breakout trading system, what does it mean actually? It means that it's a, every time there is a new high, you see the basic logic of a breakout trading system. Okay. Bullish when new high is made and bearish when a new low is made. That's basically it. Okay. And when you become bullish, you buy. Okay. So what happens is, as you can read about later, I'll just explain the logic. Let's assume that for the sake of argument, these are all 4-week highs. 4-week high. As soon as a new high is made, a new 4-week high is made. And then this is a 4-week high. It goes higher, it makes a new 4-week high. This is a 4-week high, this is a 4-week high, this is a 4-week high, this is a 4-week high. Okay, uh, and this is also a 4-week high. This is also a 4-week high. Let's assume that. Okay, so just for the sake of argument. So what the Donchian system does is it keeps on. Let's say when it's at this time, at this point, okay, or when it's at, let's say assume this is also a 4-week high. When the market is here, okay, it doesn't do anything. But the moment a new 4-week high is made, this high is taken out. Immediately the system becomes bullish, and so basically what it does at this point itself, the system places a buy stop order just above this, so that as soon as the market is above this, okay, then as soon as the market goes above this, the system goes long through the execution of the buy stop order. So when it's here itself, it places the buy stop order. Okay, it doesn't wait for the market to cross this. It already says that, you know, hey, if it goes above this, it's a new 4-week high, so I'm going to become bullish. And this is going back to the question that people asked, that is this a 52-week and is a 52-week? It can be anything. Okay, so here I'm now talking about 4 weeks. He could have talked about 52 weeks. Somebody else can talk about 14 weeks. It can be anything. Okay, that you figure out. That's why I gave the definition as N. So we are discussing, so the Donchian 4-week rule has used a 4-week high and 4-week low. And you can use something else if you want. If you think 6 weeks is better, you can. But we are understanding the Donchian 4-week rule. So they place a stop or buy stop order already here. When the market is here, they already place a buy stop order just above this, because this is a 4-week high. Then when the market is here, they place a buy stop order above this. Already when the market is here, we can see this is a 4-week high. They place a buy stop order just above this. Okay, and so on and so forth. When the market is here, this is a 4-week high. They place a buy stop order before this is broken. And if this is broken, then the system goes long. Okay. So you can use it to pyramid like this also, or you can use it to just keep it there. Okay, just keep 1 unit. Let's understand it easily with 1 unit. Okay. And then what you do is, so first thing you do is, and so you have to remember that the exit also is, the exit is based on, here if you look at the Donchian trading rule, okay. Okay, so I've given the, you can read it there, but basically Donchian trading rule is enter when a new 4-week high is made and exit when a, see if you apply this here, Donchian 4-week trading rule, here N is equal to 4 weeks. Okay, so enter when a new high is made and sell, exit when, you know, if you look at it from starting from a buying position, and you can talk about a selling position also. But we'll take the example of buying position. You enter when a new 4-week high is made and exit when a new 4-week low is made. Okay. And so what we are additionally going to assume is, let's move this to this side. Additionally, we are going to assume that these are the 4-week, we have to assume that these are 4-week highs, and we have to assume that these are 4-week lows. These are all 4-week lows. Aman, you have to be on mute. Yeah. Okay. All right. So we have to assume that these are 4-week lows. So the way the Donchian system works is, when the market is here, it places a buy stop above this, and as soon as the market goes above this, the system goes long through the execution of the buy stop order. And at that time, it places a stop for the long position that has been taken here. It places a stop order at this point. Okay, because this is a new 4-week low. If it goes below this, it will be a new 4-week low. Similarly, when the market has gone here or here, the stop, when the market is here, the stop is here, because this we are assuming is a 4-week low. And below this, there would be a new 4-week low. And so when the market is here, the stop is here, because we are assuming this is a 4-week low. When the market is here, the stop is here. So you can see this is very similar to the trend following momentum trading systems we have discussed earlier. Okay, I hope you guys can understand that this is a Donchian 4-week trading rule is a momentum type of strategy. Is this clear to everybody? Are you able to understand that it's not a mean reversion strategy? It's a momentum trading style, because you see it's very similar to the examples we discussed, that you go long and as it goes higher, you keep moving your stop higher and higher. Okay. And if you want, you can keep pyramiding every time a new buy signal comes, or you can just maintain your original position. That's for the sake of simplicity. You want to understand it that way, you can do that. And if you want to add more and more layers of complexity, you can do a pyramiding entry every time there's a new high. You can buy more. First time you go long here, another buy signal comes here. You can buy some more here, but you have to manage the risk limits and the position sizing according to the logic given in pyramiding. Okay. So understand this. So see, one more thing that what you should notice is, first of all, understand the logic of the breakout trading system, Donchian's rule. Very simple, breakout trading system, once you understand the properties. It's a trend following system, it's a momentum system. Understand one more thing, which is basically how many how many kinds of decision problems are being solved by this simple system. Buy sell bias DP4 is being solved because right now the guy doesn't know anything, but he puts a buy stop here because he knows that above this there's a 4-week high. So as he's solving the buy sell bias DP4 problem, he's solving the entry price problem also, because the entry is happening via stop order. Okay. He's solving the DP4 buy sell bias, the DP5 entry price. And what else is being solved? Exit price also, because we have a rule for that. Every time there's a 4-week low, sell it. 4-week low. If it goes below this, sell it. So put a stop here. So it is solving the problem of buy sell bias. It is solving the problem of entry price. And it is solving the problem of exit with loss. Are you following? Is everyone following this? Through a simple system like this, how you are able to solve all these 3 decision problems? Is this clear? Let's see what else is being solved. Buy sell bias is being solved. Entry price is also being solved because entry is happening through stop orders. Exit price with profit is not directly solved, but it is being solved indirectly with by 6.2 because you're trailing the stop. Okay, but position size is not being solved. I hope you guys have understood, and I hope this has been recorded. Yeah. Yes. What happened? People have fallen asleep. Have you understood? Who should we ask? Let's ask Sambhavna. Have you understood?
Yes, sir.
Okay, good. So basically, Donchian trading system, a species of breakout trading system. Understand the logic of breakout trading systems. Okay, the basic structure: all entries through stops, new highs, buy on new highs, sell on new lows. Just take one more minute. All right. Okay. So that's it basically. And so understand this and the breakout trading system, how it works, and understand the breakout trading system, how it works, and then the Donchian trading rule as a species of that, and understand that this is a momentum trading system, not a mean reversion system, and what are the decision problems that it solves for you. Okay. All right. That's it. Okay. So I'll stop the recording and the class is dismissed, but anybody has any questions can stay. If you need any extra tutorials, you can contact me and then we can set it up. But today I have an invigilation today at 5 o'clock on that system, on the new.
That has been cancelled.
No, but we still have our training session. So I can't do any tutorials for you at 5 o'clock this evening. In 4 o'clock also I have another job to do. But anyway, so but you can contact me and fix it up if you guys need a tutorial or something. You can just get in touch with me and we can organize it. Yes, anybody has any questions? Class is dismissed. The rest of you can go
Yes,
ahead.
sir. Sir, two questions, sir.
Yeah. Tell me what is the question.
Sir, 1 second. Sir, what is the full GGM?
What is what?
What is the full form of GGM, sir? I am studying this is in DP4.
DGM is Gordon growth model. You have forgotten your FM1.
Okay,
Gordon
sir.
growth model.
Okay, sir. And sir,
Equity value.
sir, the question is related to DP 6.1 and 6.2, sir. Sir,
Yes.
suppose, sir, we have given a graph, and sir, I don't know, sir, the right explanation because I am confused. Sir, suppose this is a graph which is given to us, and sir, suppose, sir, the time frame is from 2019 to present date.
So suppose you look at Amazon here. What are you confused about?
Sir, at Amazon, sir, I will go for long position, sir, because the previous low, which is at 2200 around, is not broken.
No. One minute. This is actually, if you see, actually broken here. Okay. So why would you go for longs? If you see this, if you try to read out now, I
Yeah,
think
so now it is visible that it is broken.
broken actually that 24th July, I think I'm not able to read, the font is very small, but I think visually I'm so used to looking at charts that this low is lower than this low.
Yes, sir.
Okay. So why would you be going long?
Sir, if this is broken, then I will go, sir, short.
Yeah. So you can go short, but remember, if this is your trading time frame, see, if you are going short into this kind of trend, if you're going short into this kind of trade, then what are you? Are you momentum trader or mean reversion trader?
Sir, mean reversion.
Correct. Now, what is the rule for entering mean reversion trades? If this is your trading time frame, yes, you can go short. We can see that. You can go short because the long uptrend has been neutralized. So you have a signal to go short at this point. But what is the other condition that has to be satisfied? That this is your trading small picture. This is your small picture trading time frame. Your filter time frame, big picture. Big picture has to be pointing downwards. It has to be a downtrend, non-neutralized downtrend. You must have a non-neutralized downtrend on the big picture in order to go short on the small picture signal. You remember that?
Yes, sir.
So here you don't have that. Look at Amazon. This is the biggest picture imaginable for Amazon. There is no downtrend. So you cannot go short. The only event that has happened in Amazon here is the momentum trader who was long on this time frame, who the guy who was using this kind of a zoom. That fellow had moved his stop from here to here to maybe here, and here. Eventually, if you say just this one, that fellow who was long from earlier now has been stopped out. His trailing stop has been triggered, and the guy's position has gone from long to square. That's all that has happened here. You can't.
He will stop a long position at this point, which is between July and August.
Yeah, on this day, basically, around this day.
Yeah, this day, sir, if this low is broken.
No, this low is already broken. No, so I'm assuming the guy was long from before. So if he was long from before, that means he was already, let's say he was long from many years ago. So eventually his stop gets moved from here to here, then to here, then to here, and then this one breaks. So the guy who's long from before, his long position has now been neutralized.
Yes, sir. Is now neutralized.
The long position, I mean, the trend has been neutralized, the uptrend. So the long position has been, he had a trading stop over here, so that has been triggered for the long position. So he had a trailing sell stop. He had a trailing sell stop basically at this point, and that has been triggered. So his long position has now gone to a square position.
Okay, sir. Sir, one more question, sir.
So this, in this case, in the case of Amazon, the chart we looked at just now, the only event that happened is just what I just described.
Okay, sir. And sir, one more question, sir. This graph only. Sir, if we zoom, if we go to sir all the year graph.
Yeah.
Sir, if I am a momentum trader, so I will go long in any if by looking at this graph only. Is I sir correct?
I didn't understand your question.
Sir, suppose I am a momentum trader.
Okay.
Looking at this graph, sir, will I go long or short?
No, see, when you look at, first of all, let's take the second part. When you look at a chart like this as a momentum trader, there is no way you can go short.
Okay, sir.
Because what is the momentum trader do? He trades in the direction of the existing trend. Because see, if you are looking at this, if we are talking about this particular chart view, then we are talking about this as your implicit trading time frame, which means this is your small picture. This is your trading time frame. Okay. So in that time frame, when you look at the trend, okay, then you will always assume that the current trend, if you're a momentum trader, you are always going to assume that the current trend will continue to move in the same direction.
Move upwards, sir.
Yeah, in this case, that means it's going to continue to move upwards. So here you cannot be going short, okay? But depending on which zoom you use, see, it all depends. That's why I said you have to lock particular zoom. See,
Okay.
if you use this very high level zoom, which means all we are seeing is one low here, one high here, one low here, and one high here. A very high level zoom, basically. Zoomed out. I've zoomed out a lot.
Yes, sir. You zoom.
So in this case, I can only see these one low, one high, one low, one high, 4. In that case, I would go long. If I have a plan to go long at market all the time, then I would go long at market and my stop would be here.
Stop loss, sir, will be at 1300, around 1300.
Yeah, 13, this low basically, this low.
Okay.
So 1320. Okay. But in practice, what will happen is that nobody's going to use this wider stop because it's too far away. What people will do is now they will zoom in. They will. This is all data. So they will use this as the big picture filter, and they will now zoom in and start looking at maybe 5 years. Okay, you can see a little bit more detail. And now you can see that instead of placing the stop here, you can also place it here. And maybe you can also place it in a slightly lower zoom. So then actually what you see is that this uptrend is neutralized. So let me not do anything right now. If you zoom in further with the 1 year, okay, you see this last part of the uptrend from here. And now you see the uptrend is neutralized.
Neutralized, sir, at this point, at 23 September.
Yeah. So therefore, what you say is, okay,
Yes,
okay, long-term trend is very bullish. Okay. So I'm definitely not going to go short. And as a mean reversion trader, also I don't have any logical basis to go short. But what I can do, but at the same time, I can't go long either because the uptrend has been neutralized. In my zoom level, I can see a neutralization of the uptrend. So I don't want to go long either, but what I will do is I will recognize that the long-term trend is very strong, uptrend. So this is my big picture. If this is my big picture, and this is my small picture, my trading time frame. Okay. Now what I will do is I will wait. I don't have any position at this point. If I had a long position that is squared out. Okay. At this point, I have no buying signal, but I will get a buy signal if the market moves to a new high. If it goes above this, I will have a buy signal again.
Okay, sir.
Clear? Like a breakout system.
Yes, sir. So this is the confusion which I am facing while.
As soon as a new high is made, that means the uptrend has started, has resumed. Uptrend has resumed. Okay. So therefore, I will have a buy signal. And otherwise, what I can do is I can follow this declining movement, and if there is a neutralization of this downtrend in the context of the larger uptrend, then again also I can buy. That I remember discussed. That would be a mean reversion for this time frame. That would be a mean reversion trade when you're trading in a shorter time frame. If you have like if you do something like that. Here you're following this downtrend. Okay, you're following this downtrend, but you know the big picture is up. Here, one of the things you would do is look at this high, 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 low, low, low.
No, sir. This previous low at 21 September is not broken.
That's not broken, yes, but this you are going to do. If you're a mean reversion trader, you can actually go long once this breaks, which has already happened. So as a mean reversion trader, looking at this decline and wanting to go against it, you can now go long at market with a stop over here.
Yes, sir. I will go long because previous high is broken.
Yeah, you can do that. Reason why are you able to do that? The signal is coming from here. The break of this. Okay?
16 September.
Downtrend is neutralized. Okay, the signal is coming from here. You have a buy signal as a mean reversion, but why are you allowed to do it? Because when you look at the long-term trend, there is an uptrend. So you are not going against the long-term uptrend. You are going because you are buying actually. So you are going with the long-term uptrend. Are you following this?
Yes, sir.
So if you go back and check your notes, you will see that the conditions I have given you for DP4, entering a DP4, the buy-sell bias, for both mean reversion momentum. If you look at the conditions and you always follow the conditions, then you will have full clarity on what to do. That means in any situation, what are you allowed to do and not allowed to do.
Yes, sir.
Okay, anything else?
No, sir. Sir, suppose in between, sir, can we arrange a meeting with you?
Which day? See, right now, I have.
Sir, not today, sir. Suppose tomorrow and other day.
Tomorrow you can organize tomorrow. Tomorrow you can organize sometime in the evening, maybe. Tomorrow Sunday. Tomorrow Sunday.
Yes, sir.
Yeah. So try to get maybe you can take it a few days later or something. Maybe one day. Like, try to get more people together so that I'm not doing multiple sessions or the same material with everybody. Get everybody together. Whoever's. Utsav and Siddharth are also here now. Yeah, Utsav is here. Siddharth is also here. Yeah.
Yes, sir.
Yeah. So you guys can just maybe organize something. You can do it tomorrow also, but or you can do it on Monday or whatever suits you guys. And then yeah, just inform everybody so that I just want to make sure that I have the maximum number of students in any tutorial, so that I'm not repeating the material for others. Yeah. So you fix up a time, and then generally I would prefer evening sometime. In fact, not only evening but late night actually, because then all my other things are nothing else is happening. So maybe somewhere around midnight or something like that. If it's not too late for you guys.
Sure, sir.
Something like that, yeah, is better. Or otherwise, then you do something like 7, 6:30 or something like that. But I think evening and midnight is much better because everything else is nothing else is going to happen. Midnight time is better. Yeah.
Yes, sir.
Yes, sir.
So
Sir, I had a question about this smart money and dumb money. How, sir, how the money flows from the retail investors is called dumb money, and while the institutional investors uh, are called it's called smart money. And sir, how market making operations occur? That's I was not clear about it.
So there are two questions here. The first part is the dumb money, smart money. I would say don't worry so much about that because those are basically just casual statements. Uh, I I hope you understand what they're trying to say is that the institutional investors are more sophisticated and the retail investors are not, which may be true sometimes, but it need not always be true. I'm not sure how sophisticated the institutional investors are actually. So, I wouldn't worry so much about it. There's not much substance in those statements. Those are basically casual statements. You don't have to worry about that so much. The second part, what was the question again? Second part.
Sir, about the money market operations and how the money flows from institutional investors and institutions to the market, and also there are the retail investors role in flow of the money towards the market.
No, see, retail investors will invest in, usually they invest through funds. Okay, either some actively managed funds or ETFs. Okay, ETFs, exchange traded funds. So they would either invest through those, they would actually take their savings and instead of sitting at home and buying and selling stocks on their own, they would just invest their capital in a mutual fund, is an actively managed fund, or if they would buy an ETF, exchange traded fund. That is what the retail investor would do to channel his money into the institutional investors. Okay, is that part clear?
Yes, sir.
Okay, and as far as the operation of the money market is concerned, money market is a different thing actually. Money market is a part of the debt capital markets. So you have to understand that so if you read your notes, I think in your notes I have, let's check your notes. These are not for your exam syllabus, but in the larger set of notes, don't I have a classification of capital markets? Yeah, see, in these notes.
Yes, sir. It's in debt market. Debt
Yeah.
market.
So if
Please,
you read about debt and equity capital markets, you will understand that the money markets are actually a part of the debt capital markets. So, and the other part is called the bond market. So when we say money markets in finance, you should only refer to this money market here, okay, which is in the capital markets taxonomy. You can open it and see. This is basically it. Okay. So under debt capital markets, we have bond markets and money markets. You have definition of money markets. You can see that. So in finance, when we use money markets, you should only use the word money markets to refer to this kind of market. Okay, because the word money markets has a specific meaning in finance. Although sometimes people here in India or somewhere else might use it loosely, but that's not the right usage. Is this clear?
yes, sir.
Anything else?
Sir, about the money making operations also, sir, how institutional, how that happens, and also, sir, why the 15 minutes time is allocated for these investors who set the prices for for others. Like in Indian equity markets, also 9:15, we can trade after 9:15, and from 9, something else happens.
No, that is basically, see, that is a big discussion actually, how exactly, so some of that discussion you already had in terms of your FA discussions. How do these people invest? Okay, that's what you're asking, right? How do the institutional investors invest?
Uh, Sir, what I want to understand about the money market making operations actually.
Market
How
making,
to-
yeah, so market making is, again, you have to read some of the other notes, which are already in your syllabus actually. That, have you read this one? This is part of your syllabus. Types of players.
Yes,
Have
sir.
you,
I did.
huh? So
Yes,
this,
sir.
yeah, these are so money markets. Market makers are actually a type of speculator. They are a type of speculative player. So market making is essentially, it's a volume game. If you read this note, you'll get some insight into it. But market making essentially is basically on based on which way you think the wind is blowing in the market at that time. So you will quote prices, you will slightly shade your prices a little bit based on. So if you see, for instance, if I'm a market maker in Amazon, it's a very big picture chart, but if you take a small picture chart, because market makers have a very small time frame, right? So if I'm a market maker in Amazon, I'm quoting two-way prices. So and the same logic applies to any other asset class and market or instrument combination. So if I'm a market maker in Amazon, so I'm quoting prices, let's say 31.25, 31.26. Okay, I'm just giving some arbitrary examples. So 31.25, 31.26, which means I buy at 31.25, I sell at 31.26. Okay, you have seen those prices on your EWS, buying in bids and offers.
Yes,
Okay,
sir.
remember this is also one of your uh, required notes in the syllabus, trading on quotes, bids and offers by market makers. And how do you trade? When you buy on the market maker's offer, and when you sell on the market maker's bid, right?
Yes,
So
sir.
yeah, so I'm quoting prices like 31.25, 31.26. In that case, what is happening is, so if I feel now, if let's say this is the market 31.25, 31.26, everybody's quoting around this price, and there are hundreds of market makers. So if I feel that the market is going to now move up quite strongly, then I will not quote 31.25, 21.26. I won't quote 25.26. I will quote maybe 25 half, 26 half. So I'm shading my prices to the, to the higher side because I'm reflecting my view. When the whole market is quoting 25, 26, I'm quoting 25 half, 26 half, which means because I expect prices to rise, I'm not willing to sell at 26. I'm willing to sell only at 26 half. And similarly, because of the same view of bullishness, I am willing to buy not at the market. The rest of the market is willing to buy only at 25, but I'm willing to buy at 25 half. So what will happen is when the market is 25, 26, and I quote 25 half, if somebody wants to sell, they will sell to me, not to the market at 25, because my 25 half is a better selling price. So that what it does for me is that I become long because the guy comes and sells to me. Okay, so that way I'm able to take advantage of my view. Although generally market makers don't try to take so much of a view, they just use their view a little bit, but they generally try to quote very tight prices and try to maximize their volume. That's the goal of a market making business. So you have some idea now about market making?
Yes, sir. Sir, but isn't spoofing very similar to this operation? Because they're also, even though in spoofing they don't have this intention to execute the order, but they also take a view and the market prices change because of that. Uh,
Who are
any
you talking
questions?
about? Who are you talking about?
Sir?
Who are you talking about?
Sir, I'm talking about spoofing. Like, isn't it also, even though it is illegal and the traders don't have the intention to execute the orders in spoofing, but isn't it similar that they also have this view and they try to manipulate the prices by quoting at a higher price? I'm sorry, sir, you are on mute. I can't hear you.
Oh, okay, okay. Sorry, I forgot to unmute. Yeah. So see, spoofers don't place market orders, okay? Because they might get executed. They will get very high risk of getting executed. They will place their orders a little bit away from the market, okay? They will have orders to sell around here, orders to buy around here, but they will not place orders very close to the market because they might get executed. Because remember, spoofers don't want execution. They are only trying to scare people. So what they will do is that when the market is at 31.25, if they actually want to buy, all right, what they will do is they will place massive sell orders at 31.55, 31.50 or something, massive sell orders. They will show, but they will be careful to show it a little bit away from the market so it doesn't get executed. And what will happen is when people look at those massive sell orders, when they look at the order book and they see all these orders, they'll get scared and they will think that there are many sellers, and so out of fear they will start selling their positions, and that will drive the price down. Okay, and then the spoofer will quickly cancel his sell orders and move into the market and buy using market orders. Got it?
Yes, sir.
That's what a spoofer does. So there is a difference between what I was saying and what a spoofer does, because what I was talking about is a market maker shading his prices a little bit, but very close to the current market. Whereas a spoofer is very distinctly away from the current market, because the market maker wants to trade. This guy doesn't really want to trade on the order he's placing initially. You understand the difference?
Yes, sir.
Yeah.
Okay. That's all, sir.
Okay, anything else?
No, sir. Thank you, sir.
All right, Srishti, you have any question? Okay. All right, so we'll end this session here. I hope I can recover all these recordings.
Yes, sir. Thank you, sir.
Okay, take care.